Hey, this is Sasha. Thanks for joining me in today's video. What I want to share with you today is how a call option makes you money. So how do we get into the trade of the call option? And then how does it work to make us money? So stay tuned. I'm going to answer this question for you right now in this video. All right, so if you're serious and interested in trading options rather than stocks, there's a lot of great things that you could do when it comes to trading call options to be able to profit from an upside move. Now, I don't think this is the smartest approach once you become a little more familiar and more advanced with options. I think there are better ways. For example, I would really recommend you check out the Traders Fly website here. Go to the Start Options Trading, and once you're there, there's a lot to learn in this area. So continue to evolve your education when it comes to trading options. And while you're there, feel free to check out some of these freebies that we have right here that you can go ahead and download and sign up to. Now, the thing is when you're looking at a call option, the problem with it is the time decay factor. And that's one thing that you want to be aware of as you get into this business. Now, eventually you can use time decay in your favor, but at the beginning, most people that start out with option trading, they go ahead and buy the calls, buy the puts, and their time decay works against you. So let me share with you how the option contract really works. So initially, if you're interested in, let's say, trading Apple, you could go ahead and go in and buy, let's say, the stock. And in this case, the stock could cost you, let's say I go ahead, confirm and send, about $31,000, okay? And that's about 100 shares of exposure, because here I've made my screen a little larger, so it's about 100 shares of exposure. Now, what you can do with the option contract is you could go ahead and buy a single option contract, and instead of doing 100 shares, okay, here we've got a delta of 99.79, which means it moves like 100 shares of stock, but we're only paying $2,115 for this. Okay, so watch again. So we go ahead, we buy, and we do just the stock, just to show you. Let me analyze this trade. And this tells me I've got a delta of 100, which means here we're profit and loss at a zero. If it goes up $1, stock goes up $1, how much would you make? Goes up $1, you got 100 shares. $1 for 100 shares, you make about $100, okay? So that's the way that the delta works. If it goes up $2, right, 2 times 100, you should be about $200. So you can see right there, we're up about $200. Now, to do this trade, it costs you $31,000, almost $32,000, okay? Now, if you wanted to go ahead and do this in options, I went ahead and mimicked my delta that is very similar, 99 delta, very similar to 100, and it's the same thing. We're starting out with a negative. If it goes up $1, okay, it's the same thing. You make about $100. So it's very close to the stock, but how much does this cost me? Well, look at this. This cost me, instead of $32,000 or so, this cost me $2,000. So a lot cheaper to get the same exposure. Now, what's the caveat? There's no give-me's in the market. Well, the problem here is you have time value that works against you. Look at this right here. You've got negative $31 per day that it costs you to hold this. And that is exponential. And that's why the curve is there rather than a straight line. So you're losing $31 a day. So with time, you can see I'm losing my profit and loss. If I go to the next day, I'm losing another $31. And that continues to accelerate. It goes from 31 to 32 to 33 to 34. It's an accelerated time value. It's exponential. It's not linear. Whereas with a stock, you don't have any theta problem. You don't have any time problem here. So in this case, you could basically just hold on to the stock forever. So that's kind of the difference. So when we look at kind of what's happening here is you have an option call contract. This is known as our expiration line. And you also have a T+0 line. This is this line here that we've looked at. So you really have two lines. At the bottom, we have the price of the stock. So if the price of the stock is 150, and at expiration, or today, at expiration, I would be down 800. But today, if that was there, I would be at 0. So here's my profit and loss. Anything above here, I'm making money. Anything below that 0 line right here, I'm losing money. So this is a bad thing. So when you look at this call contract and you've bought it, let's say you've bought something and the stock price goes up to 190, well, over here, you can match it up and you say it'd be about $1,200 if it went up today, right now. But, of course, if that was at expiration, it wouldn't be as much. Okay, so you can see it will be a little bit different. And if we look at this on our trade panel here, and we go in and look at this right here, you can see if the stock here goes to 350, okay, so let me move this over and zoom in on it. If it goes to about 350, well, here's my today line. This is the white line. You can see I would make about $4,574. But if that was at expiration, it would be a lot less. So you can see my profit here would only be about $2,430, so about half less. So time value is very important in these things. So if you get a shorter duration versus a longer duration, a shorter duration, what's going to happen is you have a fast time decay that works against you, but it's cheaper. A longer duration, time doesn't affect you as much, but it's more expensive. So there is always a trade-off in the market. Which one is better, right? It all depends. It depends what you're looking for. Do you want to pay more for that insurance premium or for the contract? And that's really what you're doing, is you're basically getting into this position looking for it to make a move higher, so that way you can capitalize from it. But with time, what you have is you have that time value problem that works against you. So can you just go ahead and buy this just kind of as a stock alternative? You could, and that's what a lot of people do. Unfortunately, it's not always the smartest approach because of the time premium problem. Now, in our getting started pages here, if you go to our website, there's a couple of different videos here, and we talk about more of what's the smartest way to trade options and a better way, kind of the professional way or the more advanced way that you would want to do that, so that way you can get time to work in your favor, just in the same way that insurance companies do. Think about it like your internet company or insurance company. When you make money, right, as an insurance company or as a cell phone provider or as an internet provider, people are paying you. People are paying you either to insure you or for your service, and that's what happens. Well, when you're buying something, when you're buying this call contract, what happens? Well, you take money from your pocket and you give it to someone else. You're buying a call contract. You're buying something. Anytime you buy a cell phone, you buy fruit, you go to grocery stores, money comes out of your pocket and goes to the other party. And the same thing here. So what we do normally when I look at working with people is we talk about net selling. And this is kind of called an iron condor. You can see we have two vertical spreads here. And in this setup, what goes on is we have time value that works in our favor. So you can see here I've got a theta of positive 8.62. Whereas when you look at our Apple situation, here we've got a negative 30. So we lose $30 a day with time. Whereas here in this situation, you can look at this spread moving around in this range, and every day, as long as it's in that range, you make $8 a day. So you can see right here, 1, 2, 3, that profit and loss keeps going up as the date moves forward. Now, what's the downside to this? Well, the downside is if the stock explodes to the upside, well, you don't make unlimited amount of money as you would maybe with this setup with buying a single call, because a lot of people that get into trading, they want to look at the unlimited profit potential. But as you know, stocks don't go up forever, and they don't go up like a rocket ship, and they don't go to the moon. I mean, some stocks do move pretty quickly, but it's not always the case. So what people do is they usually dream about, hey, I'll put in $2,000, and if that'll go up a little bit, to 390, I'll make 14,000. It's a good dream, but it's not always the case. It's not going to happen. It's not that easy. So my point in case is that you want to go ahead and, trade smarter. This is the way that money is made when you're dealing with call contracts. If you got to buy it and it's got to move quite a lot to offset the loss of the time value. So even if it does move in your favor right here, stock moves up, okay? If it does it in a few days, what's going to happen is you're going to be down in a few days because of the time value. You're losing time value. And with time, you're going to need to move that little extra bit to offset that problem. So here's the thing. Stock stands still here. What's going to happen? You're going to lose money because of the time value. Stock moves down, you're going to lose money. Stock moves up. If it moves up slowly, you're going to lose money because of the time decay. it's got to move up a lot and really quickly for you to make money on these types of trades. And that's why a lot of people lose money trading options, because they just do this single approach. It's the easiest approach, it's the easiest to understand, but it's not really the most successful or smarter approach. So you can see that in most situations here, you're going to be losing. Whereas if you look at this spread, here's an iron condor spread. In this case, what's going to happen? Well, if this stock stands still, you make money, right? Because you have a positive theta. You have a positive time decay. So that white line will get closer to the green line. If it moves down, you still can make money. You still make theta as long as it doesn't go down past this level. And if it goes up, the same thing. You still make money because you've got positive time decay and time value. What's the downside? What's the problem with this trade? Well, compared to the other trade, is it's capped. You have been a net seller, so you're capped on your max profits. So if I look at this trade, the most I can make is $495. Okay, so that's the max I can make on a margin of, what is that, 1505. So when you look at this percentage-wise, that's still quite a good percentage as long as you can kind of stay in that range, right? About $500 on about 1505. That's some good percentages, but you're not going to make unlimited amount like you would with a call option. And as you trade more and more, you'll realize stocks really don't go up forever. They're not going to be like rocket ships. Sometimes they do, but in most cases they're not. So I would rather have a much more successful trade, more consistency, than try and shoot for the moon like many of those other types of things. And that's what happens with a lot of people, is they try to shoot for maybe a call side here, or they try to go ahead and do kind of the same thing on the put side. They'll go ahead and set up a put contract here to try and bet on the stock going down. And they get into these things thinking, hey, well, as long as it moves down, I'm going to be good. And even if it moves in their favor, sometimes it does work out, but it moves, 3-4 days later. And by then what's going to happen is you've got this time decay problem that works against them, that, hey, it happened so much later that really your profits eroded quite a bit. So be very careful with doing these types of trades and setups, because they can bite you, because most people do these when they're new. They're setting things up and they don't understand, when a lot of times it might be much wiser to check out the getting started page here, or even invest some money in one of the courses here that we have, or if you really want to get a one-on-one session, then check out kind of the coaching or mentoring section over here, where I can work with you specifically and answer some of your detailed questions specific to your situation. So anyways, I hope this was helpful, gives you an idea of how money is made with call contracts, and that's kind of the way that it would work. But again, there are better ways to do that as you become more familiar with how these things work. This isn't always the smartest approach, but this is typically the most common approach that people take at the beginning. So it's a good step. It's a good step in your journey, but there is another level. So thank you so much for joining me. Hope you learned quite a bit. Feel free to subscribe to the YouTube channel here if you're brand new. Get some of those freebies by clicking the link over here, or check out another video as well. Thank you again, and remember to do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you next time.